VIEW went down 24% yesterday, so what happened exactly and how bad is it? Today we're going to find out, so let's do it! So why is VIEW down exactly? Well, according to the website of VIEW, according to the investor relations page of their website, we can see that they are postponing the release of the Q2 2021, of course, financial results. And why is that exactly? Well, as we can see over here, it has to do with the so-called warranty accrual. In a second, I'm going to explain to you in very simple terms what that means exactly. But here we can read that the audit committee of VIEW's board of directors recently began an independent investigation concerning the adequacy of the company's previously disclosed warranty accrual. What is exactly that warranty accrual? Well, if we go to an accounting website right over here, we can read the following. If the company can reasonably estimate the amount of warranty claims likely to arise under the policy, it should accrue an expense that reflects the costs of these anticipated claims. Now this, again, I suppose can sound very confusing, so let's make it a little bit more concrete and let me explain this to you in a little bit more of a simple way. VIEW, of course, is a company that sells smart glass. They call them in the filing, the SEC filing, the S4 filing they had when they were still a SPAC, they called these IGUs. IGUs stands for Insulated Glass Unit. Basically, every time you see the word IGUs, just think about smart glass. So, the company, VIEW, sells smart glass, right? Customers can buy these products, they can buy smart glass, and they then receive a warranty. Just like when you buy something out of a store, for example, you usually get a warranty period of a few years, for example, if the product is defective, if it has any kind of defect in those kind of years, then they are going to replace the product for you or they are going to repair the product for you. The same is basically happening with VIEW. VIEW is selling smart glass, customers are buying it, customers receive a warranty for a certain amount of time. It can be 5 years, it can be 10 years. And if something happens with the smart glass within that period of 5 years or 10 years, depending on what it is covering exactly, then the customer can simply say, well, VIEW, I have an issue with my smart glass, I want it repaired or I want it replaced. Very well. So the thing is, in 2019, VIEW identified a quality issue with certain material purchased from one of our suppliers utilized in the manufacturing of certain IGUs. So there was an issue with material in the smart glass, right? And they basically said, okay, let's do an analysis. Let's do an analysis of the exact issue at hand here, and let's then just recognize a expense, $24.5 million of expenses, for the estimated future cost to replace the defective IGUs, to replace the defective smart glass. So they said, okay, let's check out what the issue is, and let's just estimate a based amount. Let's estimate a certain amount of money that we will need to pay out to the customers because of the warranty claims. Apart from that information, we can also read in the SEC filing, the S4 filing, the following, that it is reasonably possible that the amount of cost to be incurred to replace the defective IGUs, the defective smart glass, could be materially different from the estimate. So they're basically saying, yeah, okay, based on our analysis, we think we're going to need to pay about $24.5 million in warranty claims. But in this case, it might very well be entirely different. So this could be, and I'm not saying this is necessarily the issue, but I do kind of think this is the issue. It could be the case that right now it looks like they are having more warranty claims than they anticipated. So they need to basically pay out more money to customers, or well, pay more money or spend more time or spend more money on replacing the material or repairing the material. And this basically led to VIEW saying, okay, well, very sorry, but we just cannot provide you with the financial reporting for the 3 months and the 6 months ended June 30th of 2021. So this year, basically Q2 of this year and the first half of this year. Makes sense, right? So we'll need to simply wait and see if they're actually going to have to pay more money in warranty claims or not. Now, of course, the stock went down quite a bit, about 24% yesterday, and right away we saw many companies, many lawyers starting investigations in VIEW. We have, for example, Atomy, or whatever you pronounce it, like Gibbs Law Group. We've got Glancy, Pronge, and Murray. We've got some other companies and some other lawyers and some other lawyers. So there are many, many lawyers right now that are starting investigations into the company View. Now, personally, I don't really care a lot about these investigations because very often, every time a stock goes down a lot, then a lot of investigations are started by these lawyers. Because the thing is, these lawyers are basically simply looking for new clients they can get money from. This has also happened with a lot of SPACs. As you might know, I've been doing a lot of SPAC valuation videos in the past. And basically with every single SPAC, there was an investigation from these kinds of lawyers trying to, well, simply get new money from new clients. So personally, I don't really care too much about these investigations, but I do care about that warranty situation because I am very much looking forward if they actually need to pay more warranty claims than they actually anticipated. So let's then take a look at the preliminary results, because even though they weren't able to file the 10Q, the quarterly report from Q2 of 2021, they did provide us with some preliminary results. We were, for example, provided with the amount of revenue they had. For example, they had about $15 million in revenue in Q2 of this year. In Q1, the first quarter of this year, it was about $12 million. So this went up 28% quarter over quarter, which is actually pretty impressive in my opinion, and this went up 127% year over year. So that honestly sounds pretty good in my opinion, and the entire revenue for 2021 I believe is estimated to be 75 million for the entire year. Apart from that, we also saw that View has acquired lots of new clients. They have lots of new projects, so I very much like to see that as well. They acquired a company called IoTium. Now, I haven't really looked into this company, so I'm not entirely sure why they acquired this company, and I don't even know for how much money they acquired the company. I believe that's not even present in the press release about IoTium or being acquired by View, so I'm not entirely sure. And we can also see that they still have a strong cash position of about $451 million in cash. In Q1 of this year, the first quarter of this year, that was $506 million. So it looks like they burned through $55 million in cash. Could be partially because of the acquisition of IoTium. If you look at the quarterly results of the first quarter of this year, they also spent $55 million in costs and also research development, selling, general and administrative costs. So you can see that the amount of revenue was almost 12 million and the total costs and expenses were 67 million. So the loss from operations was 55 million. So it looks like in Q2 of this year, this has basically repeated, and they are now also spending 55 million in one quarter. Now, these of course are very, very high costs. You definitely need to take that into account. They currently are sitting on $451 million in cash. So that basically means they have like 8 quarters left, 2 years left to burn through all of that cash. Now let's also do an update for the valuation of View right now, because as we can see, the current price per share is $4.13. That gives you a market cap of almost $1 billion, $950 million, which is quite insane. With the annual revenue of 75 million for the entire year of 2021, that would give you a price to sales ratio of 12.7, which is getting cheaper and cheaper right now. So that is pretty interesting. And of course, keep in mind they have quite a lot of cash, $451 million in cash, which leads you to believe that the enterprise value right now is only $500 million, because the market cap is 950 million minus the amount of cash gives you an enterprise value of $500 million, and that gives you an enterprise value to sales ratio, so basically the enterprise value divided by the annual revenue of 2021 of 6.7. Now that is actually very, very cheap. So according to the valuation of this company, the company looks pretty cheap right now if you look at the price to sales ratios, if you look at the enterprise value to sales ratios. But yeah, again, keep in mind, they are burning through a lot of money. They have very high costs. Now, ironically, I made a video about the technical analysis of View last Friday, I believe, and that was a little bit annoying, of course, but I received a very good comment from my friend Joe over here. He says, all these charts does nothing, or all these charts do nothing in the face of bad news. And he actually definitely has a point over here. And I also said, yeah, that's a very good point. And that is something that I might need to underscore a little bit more in my technical analysis videos. Because in my opinion, at least, the fundamentals of a company are more important than the technical analysis for the company. I have an abbreviation that I came up with, which is basically FUFITA. Sounds a little bit lame, but it stands for fundamental analysis, financial analysis, and technical analysis. So it basically means that fundamental analysis for me is the most important thing, then financial analysis, and then technical analysis. So yeah, fundamental analysis definitely trumps technical analysis, and we can do all the financial analysis, all the technical analysis, but even all the fundamental analysis we want, but one piece of bad news can just ruin it all, just like we have seen with View. I also want to talk a little bit about the risk of the high growth stocks, because as you might know, a lot of my portfolio right now is in crypto, which of course is high risk already. Then the stock positions I have are quite high risk as well, because many of these are growth companies or even high growth or hyper growth companies. And as you might know, I have companies like View, which is a very small position or a relatively small position compared to the other positions. But again, an investigation like this brings the stock down 24%. I'm also invested a little bit, also a relatively small position in Workhorse. Of course, Workhorse didn't get the USPS contract, which sent down the stock quite a bit as well. I'm also invested in TPGY, as you might know, because I've done quite a lot of videos about that. The thing is that maybe we're not even going to see a merger between TPGY and EVBox, which has sent down the stock quite a bit as well. I am invested in EHang. EHang had a very nasty short seller report, and that sent the stock down quite a bit as well. I'm also invested in Ag Eagle, which also had a short seller report. So it looks like, yeah, well, I might not be the luckiest person in the stock market right now, but this is just the risk of high growth companies, because the thing is, stocks with a lower market cap, they are simply easier to manipulate, and they are easier to profit from as a short seller. If you make a short seller report, for example, about Amazon, that is likely not going to bring the stock down like 25%. But if View has an issue, and if View has a market cap of like $1 billion, and if you have a short seller report about View, then yes, then the stock is likely going to trade down quite a bit. So yeah, personally, I'm still happy with my strategy. I'm still happy with the high growth strategy that I'm working with, because my horizon is not a few weeks, a few months. It is even not a few years, but it is like 5 years plus. So keep that in mind. And with regards to View, well, this was already one of my smallest positions. I'm not going to be adding for now, because the thing is, even though I still like the company and the products, I am just not sure if they can actually turn around the business and if they can actually lower their costs considerably to turn a profit in the next couple of years. So are you buying, selling, or holding View shares right now? Let me know in the comments. And if you haven't seen this video yet about the 4 reasons to not buy View shares, definitely do so. But if you have already done so, definitely check out my mission and my roadmap right over here. And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye-bye.